So I will try and drill down, as Neil asked, to look down at the corporate venture capital piece. So Taufik provided the overview of corporate venturing, how it fits into that innovation landscape. We've heard a bit about that. And I will try and look into how, in effect, Canadian corporations, along with their international peers, can get into corporate venturing. I think that's the theme of the conference. How do we get involved? How do we get into? And I'll leave you with a message of hope. I think that actually everyone here has already started that process. And actually, it's not easy to do well, but it's easy to start, and it's easy, because the tool is so flexible, to find a way to make it work for you. It won't be easy to do that, but the hope is there. And I think that will be my message that will come through. But the starting point, as we've heard a little bit through Taufik's presentation and earlier, hasn't been so ideal for Canada, and so we'll drill down into that a little bit. So just to give you a context about what we do, I used to be the private equity and venture capital editor over at Dow Jones on the international side. Before that, I was the international editor at FT Business. And so I was on the journalist front, and we were covering the independent VC firms and private equity firms and all that, raising money from institutional investors, the pension funds, the life assurers, the banks. And I had a view coming out of the global financial crisis that actually that innovation piece, that provision of capital to the fast-growing companies would become more important. And as a result, I thought the people who would be most interested in that would be the sort of corporations, governments, universities, that triple helix. And so in effect, we went out to start to answer two questions. Fairly simple guy, so fairly simple questions, which was, who does this, and what are they trying to do? And so we asked the corporation, said, what's your corporate venture strategy? How much do you invest in startups, if any? Is that directly in them? Is that indirectly through a VC fund? Do you have an accelerator and those types of projects? And we, in effect, what we were trying to do is bring that community together by asking them those two questions. Are you interested in this? What do you do? We're then able to pull together through Global Corporate Venturing and our other publications the data, the information, and then events. As Neil and Michael mentioned, the sort of conference we run down in California brings together about $4 to $5 trillion of aggregate annual revenue from the corporations who attend. There's 100+ billion of venture assets from the corporations alone attending our London conference next month. That SoftBank alone is 100 billion. So we're delighted that they're able to explain a bit about their vision fund there. But what we're trying to do is say, come together, because that's actually the hope part of the message for all the Canadians here in the room, as well as we're delighted for all the international corporations that have attended. The starting point is the network, is that connection to the right people. And so I think Taufik gave a great description of corporate venture capital itself, is the provision of minority equity to those private entrepreneurial companies. And that can be done directly through, here's a startup, I will give you some money, you give me some shares in return, off you go. And then hopefully we'll see how we develop the partnerships, the connections, the procurement, the talent exchanges, the ideas exchanges that will follow. And it also can be done indirectly. It can be given to a VC fund who maybe has different incentives, and they will be trying to say, we will find those entrepreneurs for you, and then you can look through and see some of those ideas, initiatives, and then maybe get the connections through it. So it's that direct and indirect that's probably very important. But I'll probably give you a sense of actually how to start that by giving you an example. So, the conference that Neil attended, BP was there. BP, big oil major, they're interested in ventures, they're interested in innovation strategy. They were chattering away to Schlumberger, one of their sort of, in effect, service provision companies. And Schlumberger said, we've got 150,000 trucks on the road at any one time providing kit to you guys, for your oil services. No, that's quite a big cost for us because, fuel. Is there any way that we can reduce our fuel cost? And BP said, actually, one of our portfolio companies is called Peloton. And they kind of link up trucks, in effect, as they're driving along the road. And they say by linking them up effectively virtually, they improve the fuel efficiency because they reduce the wind resistance as those trucks are driving along, kind of like a peloton in a cycle race. They form up and they save their efficiency, and the trucks can swap round, and it's quite a smart piece of kit, really. So Schlumberger said, oh, that's great. That might really save a couple of percentage points off our cost. That's a lot of money to us, and that's directly to the bottom line. And so they said, well, could we get involved with these people? And they said, oh, well, actually, we've got a round coming up with those folks, later. And so it's just been announced as a public deal. Schlumberger were in the sort of, I think, the B or C round for Peloton. It's a nice 30 million deal. But the reason why they're doing it became clear. And it only came out because you get the right people in the room, the people here, and they say, hey, we've got this business need, or we've got this opportunity. Who could help us? And corporate venture and corporate venture capital is a nice way of saying, let's find the right people in our organization that you can then talk to. Maybe we invest, maybe we don't. If we see 1,000 companies per year, we might invest in 1% of them. But we might form a business relationship with 5% of them. What's more significant to the company longer term? The 1%, maybe you get a financial return, or the 5% where you maybe have strategic initiatives, or a combination of both. Will you get the one without the other? It's an open question. And I think this is what is corporate venture in opportunity, is to think that the flexibility of the tool allows you to say, we can have purely strategic aims, we can have purely financial aims, we can have a bit in the middle. We can have the blend, a bit of strategic. We don't want to lose money. We want corporate venture to be, or the corporate venture capital bit, to be a profit center. Unlike R&D, which is often seen as a loss center, which is why, as Taufik so eloquently showed, we've seen R&D go flatline. To give you a context of that, just if you look at the ICT and healthcare industries, 2011, say healthcare was spending about 14.5% of their their turnover on R&D. Roll the clock forward 5 years, and it's about 13.5%. So that 1 percentage point drop has actually been reinvested in other areas. They say there's no point giving an extra more money to R&D in and of itself, but how do we invest that more broadly in our innovation strategies? And the slide I'm showing you here is just trying to say, effectively, don't look at which bit of this we should be trying to do. Should we have a fund? Should we just invest directly off the balance sheet? Should we give the money to the third parties? Should we link up with other corporations with similar aims? All these are valid strategies. What you, as the opportunity for the corporations here, or for the Canadian corporations, is to say, there are these tools out there. How do you think about what will be right for you? What are the questions do you ask? Taufik, I think, really eloquently gave that sense that it's how do you think of the strategic, the financial? How do you understand whether you want near-term, opportunity, that fuel efficiency for Schlumberger, or are you trying to be more, more sort of ambitious, that really transformative? Maybe it's a combination of all of that. And we got some Canadian examples here. I think Neil sort of hit the nail on the head. That actually, at the event we did in January, there were 2 Canadian corporations there. We're delighted they were both there. But there wasn't a huge number of Canadian corporations who were that interested in it. But there have been, and they've tried different approaches, and some of them have been very successful, and we'll talk about that later. So to give you a context about, Canada is about 2% of global GDP, as an economy. If you look at the sort of deals that have been done just in terms of corporate venture capital, this is nearly 2,000 deals last year, of which a corporation took a stake in a startup. The value of the rounds that those deals, those nearly 2,000 deals were done, was nearly 90 billion. That's quite a lot of money these rounds are invested. Now, the value of those companies longer term could be higher, could be lower. We don't know where we are in the cycle. But I think what we're seeing is that more corporations globally are understanding that they have to find some way of getting involved. They have to get in. To use the theme of this conference, they have to say, we have to start. We have to engage in some way. And this sort of chart shows that last year, 965 corporations took a stake in one of those deals that I showed you before. That's quite a lot. That's up. The trend is up. But the interesting part is when you run the analysis over the past 5 years, from 2012 to 2013, 14, 15, 16, that 5-year period, there were actually 1,667 corporations that took a stake in a startup. So why the delta? Why the difference between 1,667 that have done deals and 965 that did a deal last year? Well, the reason is some stopped. Some were, they had a management change. They had other issues. And so the hope that I gave you at the start, which is you can get involved, you just need to find the connections, you need to find a way to meet these people and then decide what works for you and how you approach that, is there. The challenges are equally very real. That if you're going to do this and you're going to do this longer term and you're going to do it successfully, it's not that easy. And so that 1667, the top 20% of those corporations that had done the deal are responsible for 85% of deal flow. So there's this enormous difference between the Qualcomms that Tawfiq mentioned that took a stake in Xiaomi. They had a big exit last year as well with Cruise Automation. Invested in the seed round for that company, took a nice stake. That company, within 3 months, was acquired by General Motors for more than $1 billion. Fantastic. That level of professionalism, that level of skill that they developed in the team, took them nearly 20 years to build up. It is a long process to see the returns, and unfortunately, a lot of corporations don't necessarily have that longer term, how can I phrase this nicely, that longer term perspective to stick at it and find and understand that actually the strategy that you have at the start won't be the strategy you'll probably have 3 to 5 years later, certainly won't be the strategy you'll have after 10 years. That there's this evolution and this change, but you've got to stick at it. And so the hope, I think, is very real. The challenges are equally very real. Corporate venture capital has been around for 40 years. A lot have been waves of this. There have been different approaches. It's always been seen as a pro-cyclical industry. But actually, the real opportunity is to understand that a lot of groups, particularly this top 10%, the top 20%, the 240, 250 corporations that have been doing it very well, can really exist. And so this slide just shows a number of the members of what we call the luminaries within the Global Corporate Venture and Leadership Society. So this top 20% is trying to be identified. They're trying to share the best practices. The 30 that Neil and us, we invited up as part of the delegation for here yesterday, and they're all in the room as well. I can see a number of them here. They actually are willing to come up because they are saying, we want to meet you because you've got the technology, you've got the corporations, we want to engage with you, and also, by the way, we've also got 10, 5, 15, 20 years of experience in doing this. We've got the war stories, we've got the scars. So don't hesitate to ask them, because that's actually the most valuable bit of this whole opportunity, I think, that BDC is so wonderfully seized upon, is to say, let's bring people together. And you've got this opportunity. You've got the opportunity to invest together and learn together. So, and I want to say here that Intel, obviously they've been doing it 20 plus years, invested more than 11 billion in 1,000 plus companies. Wow, that's amazing. They've really got this amazing team. They're really trying to do it. Tencent, to give you a great example, Tencent, they were corporate venture backed 15 years ago by Naspers, a South African media company. Naspers still owns a third of Tencent. Tencent in September became China's largest company by market cap. So you own, having invested 30 million 15 odd years ago, Naspers still owns that stake, and that company is worth, I forget what the figure is, 350 billion or so. That's some return, and that's still developing. Tencent, to give you a sense of how they've gone from effectively zero in corporate venturing. Last year, I think and the year before, they put out 5 billion of equity themselves in 100 plus deals. Wow. Now, most Canadian corporations, whether you're a SoftBank or whoever it might be, aren't going to start there. They're not going to necessarily have that ambition. But it shows that this can be done. Tencent will put 100 million in the seed round in a deal. But equally, they will invest in a large company and take out a much later round. did Xing. And what you see is this cascade that once people start doing corporate venturing, and once they start to see some success stories, that encourages more. The portfolio companies of corporate venture-backed companies are more successful, more likely to exit, more likely to have stronger revenue, patents, ICT, all the good things that people want, and they're then more likely to take that tool and reinvest in other companies. And so I've given you great examples. There's a load of wonderful companies here, so they're really exciting. But what we see, and equally there's some great opportunities, is that a company a couple of years ago called DJI, people now know them, the good maker of drones. When they raised their Series B round, they raised more than they wanted. And everyone's like, why would you raise more money and be diluted? But the investors were so keen to give them this money and said, we don't know the drone ecosystem as well as you do. Can we give you more money? You set up your own venture fund and invest in it. Because the competition for a startup doesn't wait until 3, 5, 7 years until the company's got some traction. Can you see if it's working? Is the idea is good? The competition starts the moment people have thought about the idea. Kickstarter, which is a crowdsource and equity platform, has been around. Company will be started on Kickstarter, and as they're raising the money, 100 clones will be out there also having raised money or also started and saying, would this idea work? So I will just say that all these slides are available. I wanted to leave you with a sort of a message of hope that how to get started. But these slides are effectively to provide a bit of air cover, so when you go back to the office and you talk to your CEO, and as Ross says, we'll be talking in a couple of weeks about this, and they say, what's the data? How do we do it? Can you give us some examples? You can show them these slides and say, boss, I'm one step ahead of you. We've already thought about the different things. We just need to work out what our strategy is. So to give you a sense of where Canada is, it's about 2% of deal volume, about 1% by deal value of the global ecosystem, which sounds okay. If you look at the sort of traction, it's across different sectors. This is CVC investors in Canada-based sectors. It's across a number of different sectors, a lot of interest. If you look at the actual top investors who are based in Canada, you see a number of lists. And then when you start to drill through the numbers, and I think this is the really important bit, is the figures don't necessarily stack up as well as they seem. If you look at some of these companies, like perhaps OpenText, we obviously heard from Tom earlier today. Well, OpenText, some of their deals, they've taken a 19.9% stake in a commitment in OpenText Enterprise Apps Fund. Those have done the deals, so they count. But then Tom's also a big investor through the VCAP program, or VCI, as Vicky is. It's now known for the next iteration. So they've taken a wider view. That wouldn't necessarily should show up in the data if you just look at corporate venture capital, but they're important. They're trying to show leadership. They're trying to say, here's what's right for us. It's not about the data. It's about what's right for the corporations. Again, and I think this is one of the real opportunities for Canada, and I will sort of talk very quickly through these, because then I think Taufik and I can then come back on stage and see if there are any questions behind both of our presentations. But if you look at the top CVC investors in Canada-based enterprises, very few of them are actually Canadian corporations. So what is it that international corporations are seeing in Canada that the locals aren't seeing? And I think I will give you another example here, which is quite a great one. I had the great honor and privilege, thanks to BDC, to meet up with Paul Santerre yesterday, who's like a legendary professor in electricals, biomechanics at University of Toronto, really involved in the incubators there. And he said, he gave me a perfect example. He said, look, we've raised about $35 million in our company Interface. DSM have just come in. DSM are a Dutch chemicals, advanced materials type company. They've just joined us earlier this year in our syndicate. We're really happy. Canadian corporations aren't in that deal, as far as I could tell, from what he said. And if you look at this slide here, and I think, the potential opportunity is to say, we see a number of corporations, in effect, the only foreign ones, which is where an international corporation like DSM will invest in an interface, but no Canadian corporations are. And we see a number of deals where Canadian corporations like TELUS or Rogers or whoever it might be will invest in a Canadian entrepreneur, but we don't see much in the middle, that green bit. For those on this side, and I think from my perspective, the opportunity through the vision of BDC from setting up this conference was about saying, let's bring some of these communities together. Let's give some examples so that you can feel there is hope, there is a way to get started with the recognition that it's not going to be easy. You will have to change and iterate. Complacency is definitely the enemy. And I think sort of Tom Jenkins also, summed it up really nicely, where he said the biggest risk, when I'm very fortunate, sat next to him for dinner last night, and I said to him, OpenText, what's your biggest risk? And he said, our biggest risk is doing nothing. So with that, I will say thank you very much and see if there's any questions.
I have about 300 questions between the two presentations. We unfortunately only going to have time for a couple. Jim is with us for the rest of today and half of tomorrow, so you can feel free to grab him there. The slides, Tawfiq, can we share those slides with this audience?
I'll send you a version.
They'll send me a version. Okay, great. Now, so questions, though, that are burning at the moment. Anyone? Oh, there's one. Okay, Mike is coming your way.
Good morning. I'm Jennifer Pierce with TransAlta. We're an energy company based in Calgary, Alberta. What seems to have been consistent through all of the presentations is the conservative nature of Canada's capital deployment. Can you talk, and it's interesting, we have probably venture capitalists in the room, we probably have large corporations with cash flow, and so probably some wealthy individuals here. What is it about the Canadian conservative financial structure that's inhibiting us to take on more risk with our capital? And what do we really need, as a nation of investors, need to do to get over that hurdle? And we talk about corporates, but we do have some wealthy individuals, and I don't know if it's like fundraising, but you get more from a wealthy individual than you would from a corporate donor. And can you talk a little bit about, and I don't know if our program has actually financiers on it, but that might be a good ad for next time. What is it we need to do in Canada to get more of our cash flow to higher risk investment to support the development of our venture capital industry in Canada?
Sure, it's a great question. I think, in some ways, there's no real reason why it shouldn't have been happening, so therefore it's hard to say what the issue is. I think, if I thought about coming to Canada and having met a lot of Canadian corporations here, it's perhaps a bit understated. So I'll give you a great example. So BDC, everyone knows here, biggest investor, fantastic work that they've been doing in the past 5 years under Michael, with Neil and the rest of the team. And they say, right, November, we're going to launch a Women in Tech Fund, $50 million. And everyone goes, great. You talk to BDC and they say, oh, well, actually, it's 70 million. We just, and you're like, hang on a minute. If you talk to every other country, they're saying, we're setting up this $1 billion fund. We're going to invest. We're not going to tell you the time period. We haven't got the money raised, but it's going to be $1 billion. It's going to be this, and it's going to do all that. And yet Canada, which has actually put some money aside for a really good project and hired, Michelle, who's going to be great at the role, and it's going to really be an interesting sort of development, is saying, well, actually, we don't necessarily want to say how much it is, and we don't want to come across too well. So, I don't know whether this is the answer or not, but I will definitely say that there is not necessarily a huge number of people saying, here's the example of what we're prepared to do. We've got some great examples here, like the Mars campus, which I think is John, who sort of had the initiative behind that. Or we heard from Tom Jenkins saying, had a couple of bottles of wine at the kitchen table, and then off we went. We started to do it. So there are some great examples, but maybe there's a sense of understatedness which says, maybe we shouldn't necessarily try too hard ourselves. There's complacency that's been talked about. So there's no reason why. I mean, there's, massive amount of cash within the state, and others. So that will be sort of one thought that I've got. have some examples and say, yeah, let's go for it. And if maybe we've exaggerated, not necessarily too much, but maybe we're being a bit more confident about what we can do, then, reach for, as the old saying goes, you reach for the stars and you hit the moon. That's still further than you would have otherwise got. But Tawfik, I'm not sure if you want to sort of chip in as well.
Add maybe a perspective and leave it to the Canadian to be maybe a little bit less polite on the answer here. We're a net exporter of capital as a country. I don't think it's a good thing. I don't think it's a normal thing. It just means that our capital chooses to deploy elsewhere versus deploying here. So here's what I hear. When I talk to global investors around the world, the American private equity, I'm not talking about venture capital, I'm just across all stages of capital. The American LBO shops will tell you, we don't invest in Canada because management teams are not aggressive enough. So there's a talent issue as far as they're concerned. If you talk to, pick your name of the top 20 private equity shops in the US. So for them, it's hard to find good management teams that are gonna basically over 3 or 5 years execute the business case that a private equity shop needs to get to their 25% returns. When you look at infrastructure investors around the world, they will tell you the governance and the regulatory environment and the political decision making is just too slow. If I go to Australia, I can get basically a privatization done in 18 months, and we own an asset in a heartbeat. If I come to Canada, it will take 10 years just to get the first level of municipal approvals done, and then we have to worry about provincial and federal. And then, by the way, this is true. You see the Canadian pension plans. I mean, they're investing massively outside of Canada. Port of Brisbane, London City Airport, these are all assets owned by our Canadian investors. And I think there's something about entrepreneurs where, and maybe this is a little bit kind of your point around, it's not ambition, but it's at some point, I can get a company to be 50 million, 100 million of revenues, and I'm happy to stay there, which is actually quite untrue south of the border. And maybe that's the cultural part. It's amazing how many small to medium-sized companies we have that have no desire to go to the next step. And then finally, I think there's a little bit of the structure of many of our industries have created very large, big players, Canadian big players, whether it's banking, telecom, media. I think there's a fair amount. We run a study every year that shows the destruction, the destructive part of capitalism, where if you look at the top 10 players in any industry over 10 years, 20 years, 30 years, 40 years, how much turnover do you have? In the US, retail in the US, for example, is a great example. You look at the top 10 retailers 20 years ago, there's only one left. I mean, Sears, Kmart, all of those guys are gone. You run those same studies for Canada over multiple decades, it's the same names, by and large. And again, that can be a strength because everything has an upside and a downside. But I think there's nothing structural about the Canadian economy from a tax standpoint, an education standpoint, that would make us an underweight in capital, which we are. But there are a series of softer things that I've tried to pinpoint a few that at the end of the day make us, just a two-bit player when it comes to where global capital deploys.
Terrific. I think that was really the core question. Thanks for asking it, and we'll come back to it, I'm sure, repeatedly over the next day and a half. Thank you so much, Jim. Thank you again, Tawfik.